and markets digest the Fed with a roaring rally. There it is. That's the word I was looking for. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And just yesterday, we were talking about a Fed that took the markets to the cleaners, incidentally, as we expected here on the show, with an acknowledgement of rate cuts, but a strong pushback on the stock of rate cuts that the markets should be anticipating. Of course, the Fed and markets are still very far apart on their tally. The Fed thinks there's going to be 3. The markets are still flirting with the idea of somewhere between 5 and 6 this year. And there's been an interesting interpretation of it whereby all of yesterday's pain has turned into today's gain for stocks, which are, again, pushing up against the highs. But we are not out of the woods just yet, because finishing the week here comes January's U.S. jobs report. And that stands to be yet another reason for markets to look to the macro calendar, to worry about macro event risk, and to think about what it might mean for their favorite narrative of speculation, the Fed outlook. So what we're going to do here is we're going to take a look at what these numbers are expected to be, what they might do for investors in terms of shaping their expectations, and how that might land into asset values, what it might do for the markets. Let's begin here with a look at the expectations, which are, for lack of a better term, middling. 185,000 jobs expected to be added to non-farm payrolls. That is very well within the 105 to 281 range that we've seen over recent months. You can see that with the naked eye. We're basically idling right here, going all the way back to about the first quarter, the end of the first quarter of last year. And indeed, if we look at the 3-month, 6-month, 12-month average for non-farm payrolls gains, this 185 lands almost exactly in line with all of them, signaling that, in fact, this thing has flattened out. It's very similar sort of a situation on the unemployment rate. We're looking to get back up to 3.8%, but we can see here that's near the top of the recent range, the 2-year range, but certainly well inside of it. We've peaked there before toward the end of last year. We've been as high as 4% when we kind of settled into this lull. So this would be, although it would be near the top of the range, it would be still very much within it. And so by all accounts, this is not the kind of data that screams any kind of major deviation economically. But then again, of course, this is where things get interesting. Data that suggests we are in a status quo situation is the very reinforcement of a status quo that had the Fed pushing back on rate cut expectations barely 24 hours ago. Just a day ago, the markets were deeply concerned that the Fed is going to delay cutting rates in March. They fell out of a recent high and moved sharply lower. In fact, the sharpest one-day down move in months yesterday, all because Fed Chair Powell said, look, I don't think that a cut in March is likely. That's not our base case. Oh, and by the way, the economy is doing quite well. It's turned out that it's actually stronger than we, or frankly anyone, anticipated. But the interpretation that the markets have come up with to square that into a rally today is really quite interesting. And how these numbers factor into that is even more interesting still. If we take a look at how this has evolved, note that between yesterday and today, and indeed the beginning of this week and today, we don't have fewer rate cuts on the menu, we have more. We thought there was going to be fewer of them a week ago. Now we are back to guesstimating that there's going to be more optionality for a sixth cut, not less optionality for a fifth one. So this is seemingly saying, okay, Fed, you don't want to cut in March? Fine. You'll have to cut more later because we're going to get our cuts. Because you still have to do it 5 times and maybe even 6 times, which is something the Fed pointedly pushed back on. And so what we see today, yesterday was, of course, this violent decline, and today we're briskly making our way back toward the highs. In an environment not where the market says, oh, okay, the Fed told us the economy's okay, we don't need as many cuts for good reasons, for encouraging reasons. Let's buy stocks because the economy is doing well. That is not what we are seeing here. The markets are saying, oh, so you don't want to cut in March? Fine. You're still going to cut as many times as we think, just later. As a matter of fact, you may have to cut more because your delay will mean you need to play catch up. This is, of course, a very interesting way to go into jobs data that does not scream a need for rate cuts. Because even at pure baseline, it reinforces the continuity of exactly the world in which the Fed doesn't want to do them. And this is why. Here's what the Fed is looking at. In the blue bars here, what you see is the supply-demand balance for labor in the U.S. economy. Not surprisingly, when you get the onset of COVID in early 2020, there is a giant surge because the economy is put on lockdown. People are out of work. There is a huge oversupply of labor relative to demand. It peaks at 18.3 million workers. Then as the economy starts to reopen, not surprisingly, that number comes briskly down, but also inflation starts coming up because, of course, those workers returning under, needless to say, not ideal conditions, especially in the beginning, they start to command wages that are much higher. Demand for them is quickly increasing. The situation is only tenuously better. It becomes even better as vaccines come out. And then you get a pickup in inflation. Now, of course, overall inflation we can see come up with the PCE numbers here, both headline and core, and then come back down as the Fed begins its tightening cycle. At this point, as we can see, we're steadily declining, moving in the right direction on what is the Fed's favorite inflation gauge, and seemingly have the runway to keep going in the same direction. However, it is a very different story when it comes to labor costs. Note that headline PCE has come down from 7.1 to less than 3. So it's moved lower by over 4%. The core has come down from 5.6 to less than 3. So it's been cut almost in half. The employment cost index, which we just saw an update for this week, has come down less than 1% from the peak. And of course, what we see as the reasoning for this is now a significant deficit in labor supply relative to demand. Now, of course, that deficit is not nearly as dramatic as it was toward the beginning and middle of 2022, where we can see that deficit was as much as 6.1 million workers. It's been whittled down at this point to 2.8 million. But the deficit persists, which is why the prices for labor are still holding up. And as a matter of fact, the deficit has increased over the past 3 months. Narrowly, but increased nevertheless. So if you're the Fed, you're looking at this and saying, well, this is why I'm not cutting. I am not cutting because labor costs are still trapped and holding up inflation as long as this deficit persists. Now, as we can see, even before the onset of COVID, there was a deficit that was developing, but it was much more modest than what we're seeing here now. This largely is a demographic thing where in 2017, we really start to see the retirement of baby boomers gather steam. And they are, of course, at this point in time, the largest cohort in the labor force. As they start to exit, you start to get an overall deficit developing because there is not younger generations to step in the kind of volume that baby boomers are leaving to replace them, and certainly not with the expertise. Baby boomers are leaving mainly from senior roles, and the Gen Xers behind them are a much smaller generation. Elder millennials behind them are larger, but they're still not enough to fill those senior roles and to fill the expertise gap. And so there's understandably a deficit, but it's a deficit of 1.2, 1.5 million. It is not a deficit of almost 3, nearly double the average before the pandemic. So this is really the Fed's concern. They would like to make sure that inflation is going to come down. And that means not locking in these wage costs. That means squeezing them out and rebasing before you declare victory. Now, if we look at the makeup of inflation here, of course, we just got that PCE update. We've seen that goods inflation has been squeezed to almost nothing, and that's been largely the way that we got down from the highs to where we are now. Most of the inflation is still baked into the service sector. If we look at the makeup of that inflation, we can see that obviously the outsized component here is housing, but of course, as we've talked about many times on the show before, there's nothing the Fed can do there. In fact, it's largely the Fed's own doing, because their rapid rate hikes have basically driven buyers and sellers out of the market. Sellers don't want to sell because they don't want to buy something else at mortgage rates that are 4% higher than where they financed their existing home. Average outstanding mortgages have a rate of something on the order of 3.5%, 3.6% at this point. For current markets, we're looking at mortgage rates 3-4% higher. So as we look at that, it's not surprising that people don't want to sell. And if people don't sell, prices don't come down. And so buyers don't want to buy, because not only are they facing the very same elevated mortgage rates, they're also facing housing prices that haven't fallen because nobody's selling. They've fallen a bit, in fairness, but not nearly enough to make up for the dramatic increase in borrowing costs. And so there's still inflation locked here, but until the Fed cuts, this probably doesn't get unstuck. So instead, we look, if you're a Fed official, you're looking elsewhere to see where you can have impact. And in places like hospitality, healthcare, recreation, other services. All of that inflation, in particular in hospitality and healthcare, that's labor. So if you're the Fed and you're going to get data that suggests the labor market is status quo, which means about a 3 million deficit of workers and wage costs, employment costs that aren't keeping pace with the drop in inflation, you're not any closer to cutting rates. The situation gets worse if the data surprises higher, not because more jobs is bad, but because more labor demand means those labor costs are going to have a harder time dissipating. And as it happens, we have seen a run of better than expected U.S. economic data, seemingly suggesting that analysts' models are wrong here. They're too pessimistic. Here's the City Economic Surprise Index, where we've seen a push through the 1 month moving average, 20-day. That's about a month's worth of data. And we've started to edge up in relatively brisk fashion, suggesting that we're looking at a situation where at zero, which is where we were right toward the end of the year, there was a convergence between expectations and reality. Economic models finally got all but thoroughly tuned to what was likely to occur. And now there's been a change of pace. We've gone deeper into positive values on this index, suggesting we're now surprising on the upside. And we've seen this in spades last week and this week over some very key economic data. The PMI numbers out of the U.S., much better than expected, showing a much stronger economy than anticipated. Manufacturing returning to growth. As ever, PMIs operate around a 50 center line, where 50 is neutral, under 50 is contraction, above 50 is expansion. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. And what we saw in these January PMI numbers was faster service sector growth, almost 53 versus 51 expected. A return to growth unexpectedly for manufacturing, 50 versus 47 expected. And so the overall index much faster than expected, the composite 52.3 versus 50.3 expected. The optimism carried into GDP numbers, the fourth quarter results giving us a 3.3% increase annualized on the quarter versus 2% expected. We saw it again this week with JOLTS data. Job openings much higher than expected. 9 million rather than 8.75 expected, which, by the way, speaks to that very same labor demand. It's no surprise that we've seen this narrowing of the imbalance in the labor market right here from 6.1 to 2.8. But at the same time, we've also had a jobless rate that hasn't gone up. That's not because the deficit has been reduced through job cuts, although, of course, there have been job cuts. It's been mostly reduced through falling vacancies. This has been much of that decline from 12 million to 9 million. So, and that 9 million was better than expected, all of which seems to suggest that we have a very meaningful risk that these NFP numbers and unemployment numbers might well be another release that's better than expected. Now, should point out that it's not only positive news recently. We don't want to cherry pick. The ADP estimate of private sector payrolls was, in fact, a little bit softer. 107K versus 145K expected. Not catastrophically softer, but softer. As it happens, this is not a very good predictor of NFP outcomes. And so it isn't necessarily something that makes NFP irrelevant because it foreshadows everything ahead of time. As a matter of fact, they've tended to move somewhat in different directions recently. But nevertheless, this is something important to consider. Likewise, weekly jobless claims numbers that we saw. Unwelcome gains, initial claims surging, jumping through their 4 and 12-week averages and building on last week's jump with another one this week. Continuing claims, the one that suggests how long it's taking people to find work once they're out of it. That one off the lows and pushing toward the highs. And of course, we can see here from October of 2022, the Fed's squeezing of the labor market, so continuing claims going up. But these are not numbers that would suggest that the labor market is doing tremendously well. But again, it may not have to be doing tremendously well. It may only give us something that is status quo. And if it does, we are in a world where the Fed is reluctant to cut rates. And if we're in a different place here, and we do get an upside surprise in line with a lot of the upside surprises that we've had here on some of this very, very high profile, high impact economic data in recent weeks. Frankly, even just the past 2 weeks. Well, then we're looking at a situation where, because of the way inflation is lingering, and in particular, because of the way it's lingering in the labor market, the Fed is going to be less likely to cut. And this notion that no cut in March just means there'll be more later might well start to make less sense. Because the markets might reason, well, it's not that the Fed is tactically delaying March and then they'll just need to do more later. Because they'll have to go faster. Because they will have missed an opportunity. But that actually there are fewer cuts that are needed. And as we saw with yesterday's response to the FOMC announcement, where that was the front of mind worry for investors, the outcome may well be negative for stocks. We may well end up with lower bonds as yields come up. The dollar is likely to do well if that occurs. But of course, that depends on what comes out and the overall landscape and how the markets read it. The key going forward seems to be that in the balance of risks, only a deeply disappointing NFP number seems like it would give the markets everything they're hoping for. Which is to say more aggressive rate cuts. Whereas a status quo result or a better than expected one echoing recent outcomes might well start to exhaust their ability to twist the narrative into still more easing come what may. And that is Macro Money for today. It's also our last show for the week. We'll come back next week. As ever, we're here Monday through Thursday right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what to expect thereafter. I'm also on with Chris for Futures Power Hour on Fridays. Not tomorrow, though. There's some special programming that we're going to have in that time slot, but Futures Power Hour on Fridays comes back next week. On with Tom and Tony for First Call on Sundays. writing for the news and insights section of tastylive.com, and opining sporadically on the platform formerly known as Twitter at @IliasPback. Thanks very much for joining. See you next week.